Welcome to another episode of Options Discovery. Today I'm sitting down with Jermal Chandler, the host of Engineering the Trade. Jermal, can you give us an overview of your background and how you got to where you are today?
Oh man, that's always an interesting question because definitely don't have a traditional sort of inroads to this background in doing financial stuff. So I was a chemist. I did chemistry as an undergraduate student, and then I did a master's in material science engineering. And I have this basically former career where I worked in labs. I did research. I have published papers that are out there under my name, and I basically decided to pivot because I wanted something different. I was looking for a different challenge, and so I jumped into the world of options trading, mostly because at the time I was still a graduate student, and moving into basically the ground floor is trading equivalent pay. Really wasn't that much different. And I was really interested in trading. I still loved science. I still do to this day, and math. And actually, a lot of those things that I learn, I still apply on a day-to-day basis, to be totally honest. But yeah, I jumped into options trading. I worked at a firm, Peak Six Investments here in Chicago, and I worked there for 9 years. And I started off as a trading assistant, and eventually you after a certain amount of time, like anywhere from 6 to 9 months in, eventually if you've done well enough, you get a portfolio. And so yeah, I had a portfolio with them for 2 years, various different trading sizes, I should say. I started out like 250,000, and then you progress, as long as you're doing well, you get to progress and move forward after every review. So it was about 500,000, and then 1 million, and then 2 million. And but to be totally honest, I did well on my portfolio, and then I had times where I struggled. But I would say I learned the most by working with senior traders and helping them trade. And when I ended up having a collaborative effort to work in a group, I jumped all over that chance, and I worked in a group with a couple of other senior traders. And it just so happened this was around 2008, 2009, which was really volatile times in the market. And I have to say that was the lasting impression. Like, I learned so much working with them. I ended up working with them for an additional 5, 6 years, and that was probably the best experience that I had there.
So just to go back on your, I guess, history with like chemistry and things like that, did you realize that you liked trading and in the finance industry while you were in school, or was it something you kind of developed after that?
Yeah, that's exactly it. While I was in graduate school, I sort of found trading, and I started talking to different friends who had been trading a little bit. Started watching, a few more shows here and there, reading a few more books. It all stemmed from the fact that where I was in graduate school at the University of Wisconsin, and my mother lives in North Carolina, so I would travel back and forth on holidays. And a lot of times, especially back then, this is pre, iPhones and all this stuff. I'd go to sort of a local, like a store or whatever in the airport, and get magazines. And the things that I was reading just wasn't fulfilling, right? It was like celebrity stuff, and then et cetera. And so I started thinking, let me figure out a way to learn a little bit more about financial stuff, because to this point I'd barely taken any financial classes. I was, you're in the science and engineering path, that's mostly what you're taking. And I thought it would be good for me to learn a little bit more about, what to do with money at some point or another when I do get a job, because I had no idea, about any of that stuff. And so never did I realize it was going to take me on this journey of trading. So as I started to gain more hunger for information around trading, just so happened that it coincided with a time when I had a career change. And so I had an opportunity to either work at an engineering firm, but it was further out in Oregon. And by this time I had had a couple of kids, and I didn't want to, sort of move them all around. Or I had an opportunity to come to Chicago and work at a trading firm. And those are my choices. And I chose the latter just because it was still a little bit closer. It was not too far away from family. And I could also sort of go down this path that I had been interested in anyway.
Well, it was really interesting kind of hearing that pivot from the STEM field to kind of the finance field. And I agree. I think Chicago is definitely a place to be. So I know more recently in your career, you focused on market education and journalism. What kind of influenced you to make this pivot?
It was interesting. So after trading at a firm, I ended up I was trading on my own for about a year and a half. And that was really great because it was the first time I really became what's known as a retail trader, right? Trading my own money, having my own time to do whatever I wanted. And at the time, that was, really liberating, right? Then not long after that, I started to look around for jobs again, and I really wasn't sure how I was going to go, whether I was going to go back into finance or maybe pivot again and go into engineering. And the first job that came my way was related to the financial field, but a different area this time. I went into FINRA, which is a regulatory field. And if you ever heard anything about that, it's a little challenging for traders to go from trading to regulatory because you're so used to looking at the market in one way and regulators look at it a whole different way. But I tell you, it was really great for me just to sort of see that area of the field. And so after working at FINRA, I ended up getting a job at Chicago Board of Options Exchange, SIBO, as it's known now, and same area, still in the regulatory field, but they also had this after about 2 years in that area, they have this educational part of the company, which is known as the Options Institute, and I applied for a gig there, and I think it just fits so many different areas of my personality. The ability to go out and talk about options is really not too different than going out to a science sort of conference and talking about your research. Similar type of deals. And I had done that for many years. So it was kind of a natural transition. I also like the idea of explaining really hard concepts to people that maybe they don't necessarily get. And we all know that options trading is definitely somewhat of a hard concept. And so I guess it just worked out well to be able to go into the Options Institute, their educational arm, and start talking to people about options. It was a natural fit for me.
So just to speak more about journalism, can you tell me more about engineering the trade? What kind of content do you cover and what audience do you think would benefit the most from the content?
I'll answer the last question first. All audiences will benefit from it. The engineering the trade is a concept that we came up with when I started at Tasty Live in 2021. And it's essentially making a play on the idea that I used to be an engineer, right? But it's also funny because I've always noticed that science types like myself who come into the field, you sort of start looking at finance and trading and like, oh, this is just another problem that I can figure out, right? Like I can figure out a formula for it or create an algorithm, and it doesn't always work that way. Like they say in trading, things work until they don't, because there's all kind of variables in the market that are changing at any given point in time. So that was what we created the show from that type of ideology. And it draws in a lot of engineers. But the content that I create day in and day out, it really has a lot to do with, I try to meld trading and real life, right? Like different things that are happening. For example, we just had some volatility in the market today due to the non-farm payroll jobs report. And as a result of that, you start seeing interest rates go higher as a result of what we saw from the report. And so the idea of interest rates going higher, eventually, yeah, I can talk to you about the futures in the 2 year and the 10 year and the 30 year that you're trading, but it's probably a little more interesting to think about it from the standpoint of what's going on with the housing market, right? And a lot of times the 10 year and the 30 year mortgage rate, their 30 year mortgage rate is derived off of the 10 year rate. So as that's going higher, mortgage rates are going higher. And I think everybody can identify with that because people are aware of what's going on with mortgage rates because you hear about it in the news all the time, right? Or the same thing with credit card rates. So you don't want to carry a balance on whatever debt you might have right now because those rates are trending higher these days. And so I often like to do things like that, draw the parallels between what's going on in the trading world and what's going on in real life.
And that's, I guess, not too far off from options discovery because we're also just based on making like education for anyone who really wants to learn more about options. And also, I'm glad you brought up how you named engineering the trade because I was wondering, I was like, is his background in engineering the reason why it's called engineering the trade? So going on back to your history, I guess, of being a options trader, what, how much work would go into being a competent options trader?
Oh, a decent amount, honestly. And I think the first question people always want to know is how much money do I need, or how big of a trading size can I do day in and day out? And I would say the most important thing is understanding how to take risk. And I think that's what trading options and trading in general does for you. It gives you the ability to take risks. You should always figure out how to take risk and how to calculate whether a risk is worth taking or not. And I think that's what trading does for you. And so that's an exercise that really you have to kind of learn on your own, right? I think the hardest thing from what, and I don't remember it being this way, but the hardest thing for a lot of people is to click the button and actually make a trade. I would say that wasn't necessarily an issue for me. I think I learned fairly early the idea of taking different risks, and so you can't, they always say they got to risk the biscuit to get it, but that's a hard and fast rule. Understanding like risk and looking at how to take advantage of a certain trade because of what's going on right now, and what's a smart way to play it based off of your current resources, right? Like that's the hard part. So I would say that's the hard work more than anything.
I'm glad you brought up risk actually, because we're going to be talking a little bit about that later. But before we get into that, I want to go back on to the previous question. At what point do you think a professional or a beginner options trader would become a professional?
Ooh, that's a good one. I gotta say, when you learn how to, when you learn that you need to take some risk, I think that's when you really, and you deal with it. And also when you have losses, I think, when you have probably a first big loss, that's when you become a real trader, because losses are going to happen, right? And if you have a big loss, it's probably because you took on a little more risk than you probably should have, given, your current situation. But I think those times are things you can learn from. I mean, I've had, I always, the thing is like with Tasty Live, we actually have live shows that we do as well in different cities. And one of the tours that we've been doing, it's actually coming to a close in November. It's called the Bad Trader Tour. And the whole entire tour, we've been doing it for the last year and a half. We basically tell stories about times where we didn't make money or we messed up. I mean, that's largely what I've used it to do. And I always remember different trades where I lost money. I always remember trades where I made money and what went right or wrong. I think you have to learn that. And at some point, once you get used to that, that's when you really have graduated from, somebody who's just casually doing it to, oh, I really get it now. You're more of a professional trader then.
Yeah, well, it was great to hear a little bit more about your background, how you got to where you are today, and also your insight onto being a, I guess, professional options trader. So let's just talk about the main topic of today, which is option strike price selection. And we can just start off with the very basics. Can you give us an overview of what a strike price is in an options contract and why it matters to a trader?
Sure. So a strike price is essentially the area in a stock where the action is taken at, right? If you are long a call, let's say, for example, at a certain strike price, once it goes above that strike price, then your option is what's considered in the money, right? And so you got to understand what in the money is, what out of the money is when it comes to strike prices selection. But also selecting a strike price really depends on the type of trade you're doing. I mean, you want to have essentially probabilities on your side, and this is what we talk about a lot at Tasty Live and with Tasty Trade with our brokerage. You want to be able to look at the different deltas, right? The delta of your options, and so understanding what once you understand what the delta is, that will help you kind of determine what strike price you choose based on your expected outcome for your type of trade. And I'm being vague because there's so many different ways you can go with it, right? Like if you're selling an option, you usually want to be more of an out of the money type of option, which is usually probably a strike price that's further away than at the money, because those have a lower chance of potentially finishing in the money, and you have a better chance if you're selling those for those options to expire worthless, which is really what you want when you're selling options. So there's a multitude of ways you can look at it, but understanding like a strike price in general, just knowing where the action takes place on a particular stock at that specific strike price.
And I guess to be a little bit more specific on that, how does the moneyness differ maybe for a call versus put option?
Oh, well, it differs in the sense that when you have a call option, if the stock is above your strike, then that call is in the money, right? Which could potentially be good if you're long it and you want it to go up. But if it's goes down and it goes away from that strike, then you're out of the money at that point, right? But if you have a put option, if the stock is below that strike price, then that option is considered either in the money in that situation, right? And so, depending on the type of trade you have, that's when you want to be aware of whether you want the option to be in the money or out of the money.
And I guess to go a little bit deeper, how does an options contract's time to expiration factor into an investor's decision when they're selecting a strike price?
Oh, that's a big one because it It really depends on whether or not your option is eventually going to expire, right? Like that's the most important thing. You want to know how far away from expiration your option is going to be. And this is where time decay comes into effect for options, right? Like time decay, the most important thing to understand is that options eventually will decay over time. And that means their value decays over time. And there's like sort of when you're looking at what's called the fate of the option, which determines whether or not how an option decays over time, there's a sweet spot at some point in that curve. We've done a lot of research to look at this. And usually for options, that 45-day to 21-day window is a very interesting time decay window for options, right? So if you're selling options, we often look at selling options at a 45-day window and eventually look at the 21-day window to either close that option or roll it to the next expiration. So, if you have options that are going to expire in 0 to 1 days, obviously that's really important to understand where the moneyness is, whether they're in or out of the money. But if they're further out, say 30 days, 45 days, then you have an idea of how much longer you have before your option eventually decays.
And let's talk, I guess, a little bit more about risk. And I know you were talking about that in the introductory part of our conversation. So let's just say that an investor they've identified a stock they'd like to make an options trade on. How does their risk tolerance come into play when they're evaluating these different strike prices?
Oh man, I mean, I guess everybody's a little bit different. It all depends on the amount of money they have available, right? But it really depends. So say you have a $50 stock and you're interested in getting long that stock. One way to do it, of course, is buying 100 shares. That would be $5,000. I think a lot of people would say, "Oh, I don't know how much I want to do that," or some people say, "Oh, sure, that's fine. I'm willing to handle that," and you're willing to deal with the ups and downs of that stock. Another way you can put on the same type of position is selling a put in that $50 stock. And say you're interested at $40, right? That you would be willing to buy 100 shares. If you sell the 40 put, you're able to collect the premium in the meantime if the stock doesn't go below that strike price and puts that option in the money. But even if it does, the worst thing that happens is you eventually become an owner of the stock for 100 shares because again, one contract is equivalent to 100 shares. So that's another way to do the same type of trade. But a lot of people are very risk averse, right? So most people are looking at the idea of, well, this is a cheaper way to do the same type of trade, but I don't want to sell a put because I'm worried about it going in the money. And so that's the interesting thing about risk, because most people will say, oh, I can put on this 100 shares and I can leave it alone and never look at it and it's fine. But those same people are not willing to sell a put and do the similar type of action eventually with the stock. So it's interesting. I think everybody's, risk and comfort level is different. But I think once people start to really learn more about options and understand how these tools can really sort of enhance your portfolio, they'll be able to understand risk a lot more.
So I know you're talking about that a lot of traders are, I guess, risk averse. What are some strategies that a trader would use if they're the opposite, if they're willing to take a lot of risk?
I would say, the idea of selling puts, selling a strangle is considered very risky, right? Because you can sort of, I mean, if the stock moves a lot in either direction, that's one where you could either see substantial risk to the downside or unlimited risk to the upside. So that's probably the biggest one, selling a strangle. The idea of just selling a call option. I mean, these are the real riskier trades of options that I think people talk about. But the biggest thing is I think people don't know options enough to know what to expect. And I think on any trade, you have to know exactly what's your best and worst case scenarios. That's the number one thing options teaches you, right? Like the idea of understanding the risk of your trade. There's risk in buying a call option. I mean, I think a lot of people assume like that's not too bad of a trade, but the fact remains is we just said earlier, options mostly decay. So if you buy a long call option, I mean, at that point, your biggest risk is theta. And every day that goes by that option doesn't go up, in this case, because we're long the call, you're going to lose money. It's just going to sit there and decay. And so that's a risk as well. But I think a lot of people don't look at it that way is because it's just a different type of risk than just selling an option, right? So that's a huge part of the game. But I think once you start to really understand your risk and your every position has risk in every different trade, that's what you start to change and become more seasoned.
So I guess one of the main takeaways is the risk profile isn't necessarily a set category. It's kind of dependent on each trader and what they're comfortable with, I guess. So I
Oh,
have a few more questions about risk. Tell me more about the risk reward payoff an investor has when trading an option. How would a trader's risk reward payoff change depending on their selection of maybe an at the money strike price versus an out the money or in the money strike price?
yeah. So I'll keep it simple, and we'll just look at it from one trade standpoint. One of the things that when you first get in the game, you try to find the easiest way to buy make fast money, as they say, right? A lot of people will look at sort of out of the money options because those are the ones that cost the least, and most people are looking to buy. As we said, most people are familiar with once they start to learn a little bit, buying an option is an easier thing to understand and cope with than it is to selling an option. So most people will look like sort of an out of the money call, like a 30 delta call, and buy that, right? Or buy a call spread that's further out of the money with the hope that they can buy it for cheap and all of a sudden make, XYZ amount of money, right? But the truth is a further out of the money option, they have a lower delta for a reason. I mean, they have a lower percent chance of ending in the money, right? It's not to say that it can't. It's just that you always want to have probabilities on your side, like we talked about. So I think there's another way to do a similar trade, but does take on a little bit more risk. You could do a call spread that's in the money. You could buy like a 60 delta call and then sell a 30 delta call. Say it's $10 wide call spread. In that case, yeah, you're taking on a little more risk because you're paying more premium, but you do have a better chance of your options remaining in the money, right? So it's just in that alone, buying something that's a little meatier versus buying something that's not as expensive but further out of the money, hoping for the big move. I think therein lies the conundrum. You're hoping for a big move when it's further out of the money versus being in the money and planning for it to move and still having the wiggle room to make that trade.
So I guess that's a good overview of like the risks that a trader can face. So like let's say that, a trader doesn't evaluate these risks properly and they end up picking, I guess, the wrong strike price. What would happen to them, or like what's the main consequences that they would face from that?
How do you mean wrong strike price?
Like let's say they're trying to buy a call, right? And the strike price they select turns out to be, I guess, out of the money, or doesn't when it expires, it doesn't give them like the return that they wanted.
Oh yeah, well that's a good point. And if we just talk about it from buying a call, I mean, if you buy a call, that's the out of the money and finishes out of the money. Well, you're going to lose 100% of your profit, right? I mean, or I should say 100% of your investment, just from buying an out of the money call that expires worthless. That's one of the bigger things that people have to understand about options, right? And again, like we said, that's risk. It's not the same risk as being short a call and then having a huge move, big squeeze move like we've heard of before with short squeezes. But just having that long call and losing all of your premium that you paid, that's risk too. And so you lose, everything that you put into that. That's not exactly what most people sign up for, right? I mean, most people sign up for the idea of what happens with stock when you're long 100 shares, and sure, it goes down $10, you might lose $1,000, but you still have majority of your investment. Whereas in this situation, you long that call, you can lose everything. So that's something that people need to be aware of.
And I guess, going back to that same situation, how could maybe a trader adapt to, I guess, different market conditions or maybe implied volatility just to avoid those kind of situations?
Yeah, that's a great question. And that's essentially what we talk about at Tasty Live all day long, 7 days a week, every, 252 days a year, adjusting to market conditions. And so one of the things we do talk about selling volatility because of the fact that there's one thing that's given. All stocks don't always go up. All stocks don't always go down. But for the most part, volatility lays kind of dormant. It eventually spikes, kind of like what we're seeing right now. And then at some point it recedes. There's a mean reverting quality to volatility. So we're always looking at situations where we're waiting for volatility to spike. We're waiting for probabilities to be on our side to be able to sell volatility so that it eventually collapses. And that's the way we try to talk about majority of the trades that we do. So it's, again, we talked about the idea of selling options, and that's sort of a hard concept for people to wrap their mind around. But when you're selling options at times when the market is creating opportunities for selling you volatility, it's a very different situation.
So that kind of wraps up my main questions about the option strike price selection. I have a few final questions just to kind of wrap up our conversation a little bit here. What are some of the most important lessons you've learned while working with derivatives in your career?
It has to be the same lessons that I'm talking to everybody about now. Having trades that went well and knowing how to handle wins, which is a big thing. You can have a trade that you're making money on, that you've been waiting for it to do a certain move. And the funny thing about it is, most of the time when that happens, most people will be like, okay, well, now what do I do? Do I keep it on? Do I take some off? Do I take half off? Do I keep the trade and roll it to the next expiration? Those are all really good questions and things to understand on what to do, how not to be too greedy, right? Or the idea of when you lose on something, how do you deal with that? How do you deal with the losses? And the idea of kicking yourself for saying, I should have done something different on this trade. So both of those together on both sides of a trade, winning and losing, I think are the most important things to learn how to deal with.
And is there any other advice maybe you'd pass along to someone who's looking to get started?
Yeah, get in there and do it. Don't waste any more time. I mean, take a little bit of money here and there, and set aside and save. Make sure it's money that you don't need for anything. And then once you start doing that, find certain trades to put on that suit your portfolio and suit your risk style. Every single day with trade small, trade often, because it's actually one of the mantras of our company. That actually two women who are also traders and performers on our network, Liz and Jenny, they talked about that a lot, and it's a great mantra. I mean, trade small, trade often. You're not looking for just one big trade that I'm going to throw everything in and bet the house on it. That's not a suitable way of doing risk. The best thing to do is do a few things here and there, especially when the market gives you opportunities, and see how it works, and learn not only about options, learn about trading, but learn about yourself and learn about your risk profile. I think that's the best way you can do it.
Well, that is some great advice to hear, that every week we're choosing a different topic for options discovery. So do you have any recommendations of maybe a topic that we could cover next for the show?
Yeah, no, that's great. I'm excited that you guys still do that. I think I remember I've actually done a couple of those back in the day with Suzanne Cosgrove. But gosh, so these are topics like whether it's strategies or different areas of the market.
Yeah, anything that comes to mind. And if you don't have one, that's totally fine. It's just something that we ask at the end of the show.
I would say, gosh, maybe discuss volatility. I imagine you've already covered a lot of the basics, whether it's calls and puts and different other strategies. If that one's too heavy, maybe calendar spread.
Well, I think volatility is always a good topic to bring up when talking about options. Well, that's all the questions that I have for you today, and I want to thank you for coming on. I know I learned quite a bit, and I'm sure our audience did too.
Oh, thank you so much. I appreciate you having me.
If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.